Good afternoon and welcome to today's Dairy Signal. Today we have Ben Buckner, Chief Grains and Dairy Analyst with Egg Resource Company here joining us this afternoon. As always, we encourage everyone to take advantage of the hour we have with Ben and submit your questions. To ask questions, do so by clicking the three dots in the bottom right-hand corner and select the Ask Question button. With that, I am going to hand it right over to Ben.
Well, Amber, thank you so much. As always, it is a pleasure to be here, and we'll jump right in because, like normally, we're going to throw a lot of stuff at you in the next hour or so. And I think starting out very high level, milk prices have contracted quite a bit until the last couple of weeks or so. And we get the question, why does class three suddenly have a 16 in front of it? And I think that to me, the big issue, and we'll touch on all the details soon, but now it's kind of a fact based on USDA data. We're not finding total demand growth, whether it is whey, even, or cheese or butter, especially. And it is going to be difficult to find demand growth given what we've seen the last year or so, demand being very, very good. But I think it's just you've got the collision between, still no threats to milk production. And it's just gotten challenging to make this stuff disappear at the rate we'd like it to. And I'm not sure how we can change that given kind of the structure of the US and perhaps global economy. I do think demand for fat, protein, dairy is going to be very strong. But can we really grow it is going to be the big question. Fortunately, I think on the other side of this is the feed markets have shed substantial premium, kind of water falling down. And that makes sense. This is all very normal seasonally. I think there's still downside risk in the feed markets. Simply put, I think that big time price movement in the grain markets going back decades is, to me, always explained by weather. Weather looks really good outside of the US plains, and even there it's improving. So it's kind of hard for us to identify kind of a threat to large available physical feedstuffs, especially for the next 4 or 5 months. I would say, too, though, to communicate very clearly and upfront, be prepared to lock in feed supplies, in the second half of summer, even if it's on a scale in basis from current prices. We do see a more dynamic feed market, probably second half of 2026, certainly Q4. And could we see, multi-year low bottoms at harvest this year? And I think that's a concern of ours. We've got time to position for this, but locking in those, income over feed costs, milk to feed ratios within the next 60 days, I think makes a lot of sense. And locking them in longer term is our strategy. We got to start with fuel costs as well. I think this US-Iran peace accord, which every 3 hours, 24 hours, seems like we've got something and then we don't. It seems to me that we've reached kind of a stalemate position here. And I also think that fuel costs will be elevated, not for the foreseeable future, but certainly during the summer months. And we'll touch on the details on why that is. It is not uncommon for, crude oil stocks, distillate stocks to be at their lowest in the early part of summer every year, no matter what. And prices always at their highest. Again, it kind of comes back to these markets are fairly simple, short-sighted. What are supplies today? That is how price is discovered. And so we're already dealing with that time period anyway. And I think if we can't normalize Mideast to vessel flows, which even if we got some kind of deal and opened up the strait permanently, I don't think that happens for another 30 or 45 days from that date that peace is found. I think the crude markets are going to be tight. And in the background, the US energy market's getting what I think is kind of dangerously tight. We've been able to band-aid over this with US exports, giving the world market supplies. We have withdrawn a considerable amount of crude oil from our strategic reserves, which will have to be replaced at some point. And so the government becomes a buyer, at a certain price. And also, we're just finding that compared to normal, this combination of higher U.S. energy demand, lower stocks, is not bearish of these markets. And so, again, thinking about locking in fuel costs and supplies on breaks, I also think makes a lot of sense. And again, can we get this deal done in the next 30 days? Is this drawn out for 12 months or 24 months? It's just the pace that we're losing energy supplies in the US is not very sustainable. So that is the concern there. This is not going to go away anytime soon, I don't think. Milk prices stable, very difficult for us to be bearish of even spot prices. I think between now and maybe the Thanksgiving Day holiday. But again, why did we see this pretty abrupt contraction? And to me, it's we've been able to see and feel production growth worldwide, especially in the US. Argentina is this new player in, I think, the world of cheese exports to Latin America. That's all kind of old news, but still ongoing. But it's that even at current cheese prices that we've seen, even in Q1, which were very weak, just has not correlated with total consumption growth. And so we've got to contend with things like, what will restaurant traffic be for the rest of the year? What will the summer grilling season look like? Will it look a lot better than it did a year ago? Those are all questions that we can't answer today, but so far, as we've been very slowly able to back into supplies of milk, cheese, butter, powder, whey, what has been made to actually disappear one way or another, and those numbers just aren't growing again. So I think that explains why we're seeing contraction in the milk markets. But I think it's kind of a dull forecast for milk prices, at least for the next 4 or 5 months. And so we have seen, and I think this is always rooted in something. A year ago it was fat and butter. This year it's very much powder, non-fat dry, and whey, especially high protein whey concentrate, especially. It's been very difficult to produce more than we consume because of the world and the US's insatiable demand for protein. And even thinking simply about this, I think what jumped out to us working with some processing companies and protein companies, it's Starbucks putting powder into creamer essentially. It's been a big deal. And I think you can kind of see in the retail landscape, protein is in everything. And a sizable part of that comes from the dairy market. So this year it's whey, last year it was butter, but you've got this pretty welcomed and considerable premium in the all milk cash price, which makes sense. So if we can produce components well, I think the dairy operation does pretty well, at least until we get into November, December, and we'll kind of reassess the rate of stocks building Q1 2027, which we want to reiterate always occurs. That is always when the dairy markets are at their weakest. But between now and then, we've got, even accounting for this correction in class 3, pretty consistent $3 to $4 hundredweight premium in the all milk cash price. And I don't think that the powder and whey markets are going to behave much differently for the next couple of months. Butter is starting to perform a little bit better, so I think that this $3 premium stays in place until we get to December, maybe. So that leaves us with $19, $20 farm gate milk prices. I don't think you do much better than that, but that is, I think, the low end, $19, in the cash milk price would be the low end of our forecast for the next quarter or so. So it's positive. As feed markets come down, cash milk stays where it is. Balance sheets, very short term, I think, get a little better instead of getting worse. And this just shows you the heavy lifting that's been done. And it's been difficult for us to identify exactly what's happening in the non-fat dry market. I think we are starting to produce more. We're building stocks. They're tight. They're not to the point where we've got to ration supplies, but the markets, of course, felt differently about that. I think it has been in kind of rationing mode. Or this game of musical chairs has certainly been played over the last 90 days. So you get upwards of $2.40 cash non-fat dry in central US. Incredible all-time record price. I would be prepared, in as much as this matters, for volatility in the powder market. Lasting highs probably in, and one of the features of markets that are not amply supplied and are very high priced is guaranteed volatility. And so think about philosophically, whether it's corn, soybeans, crude oil, I think it's been made most clear, the energy markets. If you've got very tight implied stocks or inventories, small changes in the perception of the change in those supplies has a very big deal on price. Think about crude oil, the straight open or the straight close, that is has been worth $40 a barrel on given weeks. I think the same is going to be true for whey and powder as well. So if you were perceived that we're starting to produce a lot more powder, I think the market's not going to break 5 cents, it's going to break 20 cents. Or if that doesn't happen, we're back to 240. So I do think that, again, powder contributes pretty positively to cash milk prices, but I think it's going to be a more wide-ranging market moving forward. And the whey market just doing what it always does. You can kind of see pretty clearly in the seasonal price chart the impact of dairy or whey-based protein demand has done to price discovery. So the last 2 years, we've been finding new plateaus, and demand drivers are very important, and to us, kind of the only catalyst for finding new lasting price plateaus. So I do think that there's a lot of incentive to maximize whey production. I think cheese production also will be maximized because of whey. So I think that on balance, we're going to avoid major supply issues. But I think like normally, the whey market's probably kind of carving out its seasonal lows, and it's been smoothed out. So whey to us, is a 60 to 70 cent per pound commodity through the rest of 2026. So even with that said, it's very hard for us to, I think, mathematically forecast cash milk for the next quarter or so, below $19 a hundredweight, despite what Class 3 is doing. So these are the heavy lifters in the cash milk market this year. It's not butter, it's just kind of the ancillary markets. But otherwise, just kind of going through sort of the normal course of supply demand, and we just haven't found any change since the last signal, really the last 6 or 8 months. And so we've kind of highlighted that to really get a new structure in, let's say, Class 3 milk price discovery. You've got to change global supply output. Demand gives us a pillar of support to price, but I don't think you can be outright bullish of milk until there is supply disruption somewhere. And every month that goes by, it's just hard for us to find what that is. And in fact, we thought we were moving towards tightening raw milk supplies because March milk yield data was indicating maybe there's this kind of rapid contraction going on for whatever reason. And something we've always got our eye out for is just sort of stagnation in milk yields nationally, mostly because the US milk yield is just incredibly high, quadruple what it is in South America, higher than what it is in Europe and Oceania. It's just going to be on the margin harder to grow that thing. But then the next month, the April milk production report revised upward cow numbers, production, and yield. So milk yield has stabilized at about 0.5% year over year, which is enough given record cow numbers to keep growth intact. It gets smaller, but I think we extrapolate, year over year U.S. milk production growth of 1% by the time you get to December. So that this is ongoing just means that whatever game of musical chairs gets played, everyone's going to have their supply availability filled pretty easily. And I do think the cow number is kind of the base from which we continue to grow U.S. milk production, and that's still centered on beef prices, cattle prices. And we're kind of digesting the confirmation of screwworm that's crossed the border into South Texas. I think we all thought this was inevitable. No one thought this wasn't going to happen. Like bird flu and dairy, I don't think that it's famous last words perhaps, but it's all about the consumer, sentiment surrounding beef consumption. We learned that bird flu and dairy meant nothing to cheese, butter, milk consumption. And I don't think we're going to really impact beef consumption this summer. I think we're going to have enough safeguards. I think people will trust to the industry, and so I don't think it's going to be an issue. But what it is doing is, one, guaranteeing we're not doing cross-border trade for another several months. I think on balance, too, you're going to be losing cows, not adding them. So the cow balance sheet in the U.S. On the beef side still gets very tight. So beef, dairy crosses, like we have said every 2 weeks, are going to perform probably pretty well for another 12 months. And so I think that keeps dairy cow numbers high, milk production elevated. It's to some extent, this is not really true, but does milk become a byproduct of producing beef in a lot of the central U.S. Midwest? This is all positive to dairy balance sheet P&Ls, I think. But anyway, the beef market stays elevated, but so too will U.S. milk production. We're also at peak supplies. Again, we've kind of talked about how the markets can be myopic. What is available today? What is supply of cheese, butter, corn, soybeans, wheat, and this very moment. And we know when we think about really the entirety of the Northern Hemisphere, on a per day basis or outright, we're going to be producing an incredible amount of milk. Probably happening, this week. The Northern Hemisphere has the access to the most amount of milk that they will in calendar year 2026. We're not really seeing a lot of urgency on behalf of processors in Europe, in the US. We're seeing cash dairy markets outside the US start to sag, just because I think there's this incredible supply availability of milk. Does demand work to offset this or not? And those are the big questions that we've got. But two, if we're thinking about why we still think that hedging Q1 milk production, even autumn, winter production on recoveries makes sense, it's not just because of the US balance sheet. It's not because even dairy demand is struggling to grow. It's what we've always wanted to communicate, and this goes for any raw material, whether it's grains, energy, or dairy. It's kind of, we put a lot of focus into what's happening outside the US. And that's the reason why I think rallies, recoveries won't be lasting or intense. It's because everyone else outside the US is also producing a lot of milk. And they're faced with the same kind of struggles when we think about domestic demand consumption, food growth, tourism, things like that. That's all being negatively impacted by energy prices. And in some places, we've seen an acceleration in production, at least compared to last year, like Australia. The smallest of the exporters, but still pretty important exporter of dairy products to that growing Southeast Asian market. Production there is 618,000 tons in April. It's up 4% from last year and getting stronger the last 3 or 4 months. New Zealand production of milk in April we knew was 1.5 million tons. That was up 6%. When put together Oceania, the world's largest exporter of dairy products because of their proximity to Asia, up 5.5% from last year. And so still very strong. And similar to the US, I don't think there's a lot of evidence to suggest this changes as they seasonally rebound milk production in August and September. We'll kind of touch on, so far at least, pretty favorable weather in Australia. A lot of access to pasture, at least today, reasonably priced grain, lots of grain inventories in Australia and New Zealand. We're watching for drought development, but the big thorn in New Zealand milk production side recently has been too much rain, not too little of it. So for the next couple of months, I don't think there's a threat to Southern Hemisphere milk production. So again, what's happening outside the US that matters most to us when we think about cash milk in the United States and production's growing outside the US. We're waiting on official European block-wide production, but we do get kind of snapshots of select countries. And the two biggest countries that account for about 40% of European milk production, that is France and Germany, growth still intact. These are daily average production rates. France, 72,000 tons, is up 1% on last year. Germany, about 100,000 tons, that's up 6% on last year. So I suspect when we get all the countries put together, European milk production will grow by 2 or 3% in April and for a 14th consecutive month. So European processors like the US have access to a lot of supplies. And I know this is something that we've talked about every 2 weeks, but it's important to just acknowledge that it's ongoing as of the very end of spring and early part of summer. And I think what is also new to price determination in the United States, and we've talked about this before, but it is finally after a full year of milk production growth in Oceania, Europe, and even Argentina, the cash markets are starting to tell us that there's more than enough stuff there. So for the first time in about 18 months, this is nitpicking a little bit, but cash cheddar is 1 penny, offered 1 penny below the US block market. But I don't think that materially changes export disappearance for the next 30 days, maybe 60 days. But unlike the last year and a half, it does seem that there is competition for world cheese market share. So a concern of ours is if we get to October, November, do we start to lose what has been the star of the US cheese market, and that has just been incredible export demand. I think it stays large, but does Europe start to share in this as well? Butter is still very competitive, but we are seeing those markets sink a little bit. European butter, $2.05, down 5 cents from last week. And butter in New Zealand, $2.65, also down 5 cents. So I want to think about this kind of in terms of thinking about what does the fat market in the US do? What is the butter market? I think what this gives us in terms of guidance is we got to think about there being a pretty hard cap in butter prices at $2.05. So that market is recovering, but I think one of the features of the dairy space is just kind of the need to find demand growth, and that does get obstructed on rallies and cheese of 15 cents a pound or butter of 10 or 15 cents per pound. I guess on paper, at least, we start to lose market share, and that's just not something I think we can afford at this moment until or unless there is milk supply disruption. Again, the other thing I think what's new is just this concern about food demand growth. And so we know that retail gasoline prices are the highest they've been in a long time. Crude oil is doing what it's doing. All capital seemingly is still going into AI build outs, whether it's data centers or high-end computer chips, and it's not going many other places. So this is what we're left with. And this is the University of Michigan's on the left, the University of Michigan's Consumer Sentiment Index. And so it's an index, it is survey based, but it does kind of tell a story. And so the index as of May was a new all-time low, 44.8. So I think there's nuance to this, but I think it is telling us that the consumer is stressed. And I thought what's also interesting, and we keep track of this weekly, the EIA gives us pretty good guidance on what physical supply and demand of energy markets is. Despite retail gasoline prices being very elevated, crude oil up to $110 per barrel, we really haven't seen energy demand destruction. So what you're looking at here on the right is weekly disappearance of motor gasoline. In the last 6 weeks, it has been at or above last year. And it's been pretty stagnant the last couple of years, fuel efficiency, et cetera. The electrification of the U.S. Automobile fleet, that all matters. But I think that the consumer is driving as many miles as they were a year ago, spending more money on this. And so there's less money going elsewhere. And I think that includes to restaurants and to discretionary spending on food. So again, it's hard to really get to the details of how much food demand growth globally occurs in 2026, but I think it will be hindered by just consumers having to spend more money on energy. And they're doing that. At least as of last week, the consumer is not spending less money or driving fewer miles or driving the same or more miles nationally. So there's less money left to spend on other things. I think that's been behind what we've seen in terms of domestic disappearance for things like cheese and butter. And again, thinking about the details of U.S. crude oil, retail gasoline prices through the balance of summer, at least, it's changing very quickly. So in the last, I'd say 10 weeks, we have liquidated something like 60 million barrels of crude oil from our strategic reserves. And the graphic on the left shows you the seasonal evolution of crude stocks, including the strategic reserves and commercial stocks, the entirety of U.S. crude supplies. And so it's dropped by about 100 million barrels in just the last 2 months. It's the lowest total number since the winter of 2024. But when we think about what this means in terms of price and future price, what kind of alarms us is like I mentioned before, the collision between losing supplies, and that was to be expected given what's happening in the Mideast, but also the U.S. very close to being a net exporter pretty consistently. We're still importing small amounts of crude, but we have in the last 2 months been a net exporter at least 1 week, driving the same amount. Total U.S. inventories of crude, including the strategic reserve, now just cover about 5 weeks of consumption, and that is the lowest that we have going back many, many decades. And so I know that the markets are different, energy markets are different. Again, we've been able to rely on U.S. exports of crude. The world market has. Renewable energy is new, so it's hard to compare what's happening in Iran today with what happened in the 70s or even in what happened in energy markets in 2007. But again, it's kind of the rate of change I think is concerning. So if the Strait of Hormuz is not opened in the next, let's say, 30 days, and this continues to shrink, what's the threshold for having to rally energy markets pretty substantially? Is it the U.S. crude reserve covering 4 weeks of consumption, 3.5? It's kind of where we're trending now, and we'll continue to trend, I think, until this thing gets resolved. So to us, the risk of sharply higher diesel costs is only eliminated if there is lasting peace accord found, or if the Strait of Hormuz, is opened fully and becomes fully operational by the middle part of summer. That's not to say crude oil like today can't drop $3 or $5 per barrel in any given week, but we're not solving any real structural supply and demand until this entire thing is resolved. And this is the sort of update. Now it's become official on dairy demand. And so again, this is kind of I think the highlight of the last couple of weeks. Again, we talked every 2 weeks. We know production's growing in the U.S., elsewhere. Fuel costs have been high, but it's just that we're not finding total demand growth in cheese and butter. It's butter consumption officially in March was down 6 million from last year. Cheese was. Butter consumption was down 1 million pounds. And this is occurring despite all-time record cheese exports. And the U.S. is still a net butter exporter. So it's a domestic market that seems to be lagging. And we can only get visibility going back 6 weeks or so. Maybe it was cool weather. Cool weather probably didn't help this. It was pretty cold and damp, all around unpleasant in March. But we've got to see this change pretty quickly. And we will get new rough estimates, I think, this afternoon. So, of course, we'll revisit this in 2 weeks. But domestic use of cheese was down 10 million pounds from last year in March. And butter domestic use was down 13 million pounds. And again, it's kind of hard to grow once you're at all-time records, but this is important given we know we're going to have a lot of milk for the foreseeable future. So demand growth not occurring, but it is what's needed. So the USDA's, every month, like corn, wheat, soybeans, does give us a balance sheet, fat-based and skim solid-based. And you kind of always assume that ending stocks of milk on a fat basis will be, I don't know, somewhere between 11 and 13 billion pounds. And you back into what do we need to do to balance this out? In 2022, it was kind of a matter of rationing supplies because there was not a lot of it. And in 2026, and the USDA has been pretty consistent in this, we got to find demand growth when we think about fat-based milk of about 1 billion pounds. So we're not there yet, but that's just kind of what the market has to do to keep things balanced. We're struggling so far. So you think about what price does. Well, it's got to work to find this 1 billion pounds of fat-based milk consumption growth. What price does that get accomplished? So it's got to be reasonably priced, competitive in the global market. All of this is just kind of a symptom of having a lot of milk on earth. And now consumer sentiment, consumer spending, restaurant traffic, I think being negatively impacted. It's hard to dial into exactly what's happening with the sort of total restaurant demand, but you can kind of see in survey-based numbers, it's more people reporting, contraction in foot traffic, same-store sales, things like that. So all this is part of the landscape of what's happening in the U.S. economy today. Seasonal trends, it's been very chaotic, but squint your eyes, they're still working. And so it is very difficult for us to be bearish of spot flat prices kind of across the gamut of the U.S. dairy space, but did want to communicate that these forward premiums built into the market are largely accounting for this. So at the same time, it's very difficult for us without a change to U.S. or export or milk production or energy prices to be bullish of September cheese above $1.75. It's kind of built into price, this normal contraction of supply and demand, higher prices. The same thing with butter. At $1.90, it's probably accounted for the relative loss of U.S. butter inventory. So again, I think the big picture idea is that futures cash prices just more or less stuck and probably stays that way until we get something new, whether that is much cheaper gasoline and so higher consumer spending on other stuff, or some kind of production disruption with respect to milk somewhere on earth. We don't think that happens during the summer month. But the silver lining to this is that, income over feed costs, pretty decent. Milk feed ratios also pretty decent. And I think that these get a little bit better before they get worse, but we want to be mindful that normal seasonal breaks in feed markets are buying opportunities. That is always the case. We will kind of end this with just the evolution of corn, soybean meal price. It has not been remarkable this year. This is not a unique year, even this week with price discovery of the feed markets. But you always bottom these markets, most typically the month of August. And I think our idea is that the post-harvest or post-summer recovery could be pretty swift and pretty intense. So be mindful, pick your spot when you look at income over feed or milk feed ratios. We want to be pretty proactive, even on a scale-in basis starting now. There are a lot of scenarios for U.S. corn supply and demand, and we can't really prove or disprove either one, but nothing is really locked in like it's been the last couple of years. I think whether it's 12 months ago or really 2 months ago, you can kind of, none of your corn estimates were going to be exactly correct, but to get something that sparked a change in the structure of feed pricing, and you knew you had to get perceived yield and ultimately actual corn yield to something like below 175 bushels an acre. So that implies pretty bad weather somewhere in the U.S. Corn Belt. This year, it's kind of been flipped on its head. So I presented two scenarios here. One, we do think that we are going to end up with about 2.2 billion bushels of corn on September 1st. It's a lot of physical supplies. There's really no reason for the corn market to ration those supplies, even with China kind of looming in the background based on this trade deal that's been established. And we do think that ultimately, at least in 27 and 28, China is going to spend $17 billion on non-soybean U.S. ag products. That's got to include some measure of corn. But we're going to have 2.2 billion bushels at the end of summer. Ethanol production, just the math behind it, it's gone very poorly the last couple of months. USDA is too high there. That will offset a potential increase in export disappearance, which is still very, very strong. But the two scenarios, so the red and purple, there is a scenario that China buys 500 million bushels of corn, at which point you've got to project exports at 3.5 billion bushels. Assuming USDA's weather-adjusted trend yield, slight dip in acres are ideas that fertilizer costs, slow regional planting, you're going to plant soybeans instead of corn, maybe the northern U.S., parts of the Great Lakes region, even parts of the South. And so you're left with only 1.6 billion bushel in stocks. That is a 475 cash market. That is probably thinking about seasonal highs, a year from now, that's pretty easily 525 or better. And so you definitely want to buy summer breaks. Let the market drop like it normally does in summer, but those present opportunities to purchase long-term coverage. I think what the market's got to contend with, though, is that we can't prove any of this. China has not shown up yet. And the alternative scenario is that you lose acres, but weather is ideal. And unlike last year and the year before that, you kind of avoid heat dryness in August, and all of a sudden we've got a 187 or 188 national corn yield, at least presented by USDA in, let's say, September and October. And China only buys 100 million bushels or 200 million bushels of corn. And then you're kind of stuck with the same amount of corn next year as this year. But I do think that best case scenario is you're left with 2 billion bushel in stocks in 26, 27. And if that's the case, you just kind of repeat the last 12 months. So harvest lows are $4, spring highs are $5. In any scenario, again, there's a lot of uncertainty here. Basically, every category of the balance sheet can be filled in with any number. But in any of these scenarios, buying corn the second half of summer makes a lot of sense to us. And that, unlike a year ago, the red categorized balance sheet is a very real risk. We can't afford to lose a lot of yield or perceived yield in the U.S. We don't know what China will do, but to get to $17 billion of non-soybean ag goods, they're going to have to buy some amount of corn from the United States. But for now, again, I think the market being myopic and short-sighted, we can leverage this. Again, there's going to be no shortage of physical corn in the U.S. or North America during the summer months. South America will be harvesting corn. In Argentina, they started the very end of March, and this thing gets dragged out. The South American corn harvest does not end until about the first week of August, which is probably when harvest starts in Arkansas. So you've got this kind of 6-month harvest period. And we get physical yield data from Argentina. It is still raining in parts of Brazil's winter corn belt. So I think they are going to have a record 90 million tons to export over the next 12 months. That is 760 million bushels more than they will have exported in the 24-25 crop year. So, again, the market's going to look and feel like it normally does, pretty heavy for the next 90 days. Even if you were to present, a balance sheet that showed U.S. corn in stocks at 1.2 billion bushels to an end user or an importer saying, this is what we think you should buy corn. Well, they can look out their window and see that Brazil's harvesting corn today, so they're not going to buy corn. I think that you've got normal downside pressure through at least the first half of summer. And you can see on the right, Argentine corn is competitive and cheap compared to the US. So it kind of backs up this idea that they've got a lot of supply to get rid of. I don't think they can store all of this. Cash markets will be pressured. Soybeans and to some extent soybean meal, a little more concrete. I don't think you have a lot of uncertainty. We know crush capacity will continue to expand, but you know what it is, so it can't be any more than this 2.75, maybe 2.8 billion bushels. Incredible demand story. China and weather are key. China has said that they will purchase 25 million tons, over a 12-month period. That we think gets exports to close to 1.7 billion bushels. I don't think that fluctuates too much. It's going to be between 1.6 and 1.7. So it's all weather. So in these scenarios we've just presented, let's just call this yield perception during the summer months. If it is the USDA's forecast, 53 bushels an acre, you got in stocks of 325 million. That's a $10.50 to $12 market. If the yield perception is 51, you're rationing supplies. If the perception is 54, weather's good, it's been good to date. If you avoid heat, dryness in August, and you've got new record soybean yield, then you're building stocks, 460 million bushels. That is probably a $10 market at harvest. So this is just more normal to us. We don't have to go through the same demand scenarios. It is just, is weather good? Is weather bad? I think that will drive soybean prices for the next 2, maybe 3 months. So far, it is good. But there is value in soybeans. So I think this is important. And if we're thinking about, if we're producing soybeans, what to do with markets, it's important for us, I think, still to manage those bushels we want to sell off the combine. If weather is good, I think the market's going down. But this post-harvest, post-summer recovery, like corn, probably wheat as well, will be swift and pretty intense. And this is cash soybean crush margins in central Illinois. And it's absurd looking, but for every bushel crushed, these plants are making $4.90 per bushel. And so if you were to collide China buying a bunch of soybeans all at once with the need to crush record amounts of soybeans to meet the USDA's biofuel mandate 2026, 2028, all of a sudden you are having to ration soybean supplies. So it's very difficult for us to see, I think, soybeans, much below 10.50, just given that crush plant, if it has to compete with China, can pay $12 or $13 pretty easily. Because this has been one of the better stories, I think, of demand in the ag space. The renewable diesel, biodiesel mandate, blending 2026, 2028, it's going to grow by 40% from current levels. We can't meet that with just soybean oil. We've got to produce record amounts of soybean oil. We've got to import record amounts of tallow from Brazil and Australia, cooking oil from China. All of that is required to meet those volume mandates. So soybeans do have a lot of value. And if you're a biofuel producer and blender, you're adding this D6 RIN to your revenue. And this has been one of the stories the last couple of weeks is the D6 and even the D4 RIN price, but the biodiesel RIN price just can't rally enough to encourage plant expansion and production growth. These people are making lots of money, and so they can afford, again, to pay more than they're paying now for soybeans should a weather problem develop before China does come in and buys. I think the 25 million tons is not new. It's expected. It is below what they have purchased on an annual basis, prior to 2025. But if they come in and purchase 10 million tons in a month, that changes the calculus a little bit just because you got to put soybeans into position. That does stress the supply chain pretty significantly. But again, I think this is going to be a pretty normal market for the next 4 or 6 weeks. What does Mother Nature do? How does she perform in the Northern Hemisphere and in the US specifically? Now, these have been incorrect the last couple of years, but this is NOAA's best guess on summer conditions, as of the middle part of May. And so you can see it's fairly boring. I even think the dryness in the Northwest Corn Belt will be proven incorrect just based on, 2-week forecasts. But, equal chances of everything. This typically implies something pretty close to climate normalcy. And this covers almost exactly the principal US corn and soybean belts. Even short-term forecasts look pretty good. I think what we have been waiting for in this part of the world is just steady warmth, and we're finally getting that. Now, drought coverage is pretty substantial and has been firing up, in northern Illinois, southern Wisconsin, abnormal dryness spreading in Iowa. It's just been enough weeks since the last big rain event. But on the right, you have the U.S. Weather Service's latest 7-day forecast. And so you can kind of explain away the development of recent dryness. I mean, I think this abnormal dryness in Iowa, northern Illinois gets probably wiped out in the next 10 days. Even initial crop ratings, just under 70% for both corn and soybeans, a little below average, below last year. But that's all due to dryness in Nebraska and Kansas. And since those have been published, those areas have gotten a lot of rain. So I imagine we're going to see crop condition rating improvement in the next couple of weeks. We do need regular rain throughout the growing season. Soil moisture, subsoil moisture is not surplus really anywhere except, I think, Michigan, Ohio, and Pennsylvania. But it does seem like, and I think because of El Nino, which we are now in, we're going to get fairly regular rain. I think looking back when it gets to June 30th, it probably will be a fairly wet, even mild month. This is what, assuming the forecasts are exactly correct, what 30-day percent of normal rainfall will look like on June 15th. So still some scattered dryness surrounding the Great Lakes region, but more improvement than contraction when we think about crop health, soil moisture levels. So it looks pretty routine to us. And I think kind of like the milk markets, when we have strategies in milk, it's rooted less on what's happening in the US and what's happening everywhere except the US. And the same is true, I think, for summer prices in grain markets. So we just kind of go through the northern hemisphere, and it's just very hard for us to find a problem. I know even a week ago, one of the hot button issues in the ag media landscape was drought. It's crippling drought is on its way to southern Canada. Well, that has been proven wrong almost immediately. It's gotten mild and it's going to rain a ton. And I think the same thing is true everywhere else. When problems start to, bud, they get eliminated. This is Europe, June 1st to 15% of normal rainfall if the forecast is correct. And so what we want to focus on really is the wheat, barley crops that are going to be harvested in the next 30 days. And that is northern France, Germany, Poland, and the eastern part of the United Kingdom. All will be very wet. I think rain makes a grain still in a lot of these places. This is the Black Sea. And this is not just wheat. This is now getting into the corn growing season. And I've highlighted Romania, eastern Ukraine, and southern Russia. This is the breadbasket of this part of the world. And everything looks pretty routine. Talking to some people in Romania this morning, they say it's been the best growing season maybe ever there. And that's a pretty small but important producer of wheat and corn. So I think, these grain markets, as we get into China, maybe changing the game post-summer. They're going to feel somewhat heavy because a lot of stuff will be harvested, and there's really not been a threat anywhere except the U.S. hard red winter wheat belt. There's going to be a lot of wheat in Europe, in Ukraine and Russia, and probably a lot of corn in the Black Sea as well. So there's really no urgency in reaching for supplies today. Even China, kind of regional issues maybe, but I've highlighted the primary corn and spring row crop belt of China. This is again the 2-week kind of percent of normal rainfall. Looks adequately wet there. So there's really nowhere else on Earth that we can identify problems. And even Australia, El Nino, super El Nino possible. The biggest impact El Nino tends to have on a reliable basis, not every year, but let's call it 8 out of 10 years, will be Australia and Southeast Asia. And it's typically very hot, very dry when El Nino is present. And I still think that these regions, Australia included, will have problems come September, October, maybe November. But for now, we're always just kind of pushing back risk. It's been very wet in Australia in April and May. The first half of June will be wet enough in the west and wetter than normal in the southern and eastern crop belts. And the south and east is where a lot of dairy is produced as well. So I don't think you can be concerned about pasture or grain supply availability, even in Australia and even despite this rapidly building El Nino. So the message here is just that thinking about feed markets, milk production, world weather patterns are normal to pretty good, at least in the early part of summer. And so this is what I mean by corn price, soybean meal prices. It's been fairly chaotic, but in the end, we have done really nothing unique. So corn typically breaks pretty hard after the middle of May, and that's what's happening. Soybeans as well. Again, squint your eyes, soybean seasonal trend still very much intact. thinking about too, like whether we've had drought in the U.S. plains, Kansas City wheat, nearly every year, unless Russia bans exports, does lose 30 to 70 cents a bushel during the summer months, even if there's drought. In 2021 and 2022, kind of the peak of China's phase one agreement, buying lots of U.S. ag, Ukraine-Russian war, I think corn dropped from $7 to $4.90 in the summer because of perceived favorable weather in the U.S. And the reason I think these trends exist is because at the very top, let's think about the world grain market. We just can't physically store all this stuff. In the US, we're better positioned than most, but in Europe, the Black Sea, South America, there's just going to be grain that has to be sold at harvest. Corn and wheat harvest now stretch in the Northern Hemisphere from, in the Southern Hemisphere, because South America is kind of prolonged growing season. You get corn and wheat harvest on Earth from March to August, and then the Northern Hemisphere corn is harvested October, November. So it's just this prolonged period of supply replenishment. I think that's just why seasonal trends, as simple as they seem, just can't be changed. They're kind of unavoidable. Even soybean meal, a very chaotic market, but this market tends to bottom in August, like everything else. When we go back the last 2 decades and we kind of can pinpoint what was the exact bottom in spot Chicago corn, and most often it is August. So it's not October, but it's also not June. So I do think that's what we've all got to contend with. But unlike the last couple of years, we're more gung-ho about purchasing corn in the month of August, scaling in the second half of summer. I don't think we can afford really a lot of production loss. There's not that much corn or soybeans on Earth that we can't worry about weather and what El Nino might do to Australia, Southeast Asia, eventually Brazil, kind of 9 months from now. So be prepared to purchase feed once we get to these normal seasonal lows in the second half of summer. So that is the spiel for today. Thank you so much for your time. And again, as always, questions, complaints, rebuttals are always welcomed at any time.
Alrighty, thank you, Ben. We did have a question come through regarding the New World screwworm. It reads, now that the screwworm has arrived in the U.S., how do you see this U.S. dairy cow number changing? And then our shortage of heifer replacements and increase in herd size, you must have an older herd. Must be a comment.
Yes, starting from the back, yes, the herd is old. And that is, I guess, both a feature and a bug. I think it keeps, milk supply example, cow herd pretty elevated, but yeah, the heifer replacements, it's going to stay an issue. And the beef cow issue is going to be pretty intense for another 12 months. And I guess as we're all digesting this, and I'm not a beef feeder, but I think so far what it's going to do, it just kind of raise the burden on the feed operations. I think we can, kind of like bird flu, I think we can manage our way through this. We're coming up with a lot of innovation. Different protocols, quarantines. I don't think consumers are going to eat less beef, but if you're feeding beef cows, you're going to have to do all this work now. A lot of paperwork, a lot of quarantines, a lot of monitoring. So it's going to raise the cost burden to those guys. I don't know if it does much else than that. But again, this is all pretty new. It's kind of 24 hours old.
Yeah.
And again, I think we expected it to just not. I don't think we were going to prevent these flies from crossing the border.
Alrighty, well, thank you, Ben. Is there any other key takeaways, messages that we want our viewers to take home with them today?
Yeah, I think it's still just managing risk, managing margins in the case of dairy. And from a very, very high level, we don't see a new story, a new bull story in milk. I don't think we're going back to 14, but it's just hard for us to identify potential changes over the next 12 months. So again, that market's stuck. I think we can identify changes to feed markets, though. Again, not in the next 2 months. I think the markets will behave very normally. But after that, it's just odds are lower than they have been that we can produce more than we consume, especially if China shows up, especially if you don't have, like last year. Last year, weather was ideal every exporting country. It could happen again, but odds I think are pretty low. We're probably going to have some dicey stuff in Southern Hemisphere at some point. So just be prepared, keep those margins where they are today. I think that's going to take some, proactive managing.
Alrighty, well, thank you, Ben, and thank you everybody at Ag Resource Company for their continued support of the Dairy Signal. We will see everybody next week, Tuesday, and have a great weekend.